A very good evening and a warm welcome to Personal Finance. I'm Gugulethu Cele. Now today I'm joined by Lezanne Human, who's the Chief Executive of FNB Savings, Investments and Fiduciary. And today we're taking a look at how you can take advantage of higher interest rates following the recent announcement by the South African Reserve Bank that the repo rate will increase by 25 basis points to about 7%. Now this means that the prime lending rate will now increase to 10.5%. All these huge numbers, and Lezanne, whenever we read them, I think for those of us who have some kind of exposure to credit through a bond or a credit card or other short-term expenses, we cringe and worry, but there's a good side to the story, right?
There is a good side. So if you think of the petrol prices increasing, there's not much of a good side there. In this case, we have a good and a bad side. So yes, people will have less disposable income. Yes, it will be more difficult to service your debt. But the good side is that if you have something invested in a cash savings or investments product, then you will get so much more than before. And everybody should have a bit invested in a cash investment product.
Exactly. So, yeah. Talk to us about that, because so often when we think cash exposure, we think pensioners because they're slightly more conservative and don't want exposure to equities. But someone in their 20s and 30s also has exposure to cash, right? And should, effectively.
Absolutely. So I think anybody in any stage of their life should have some form of exposure to a bit of cash savings or investments. If you think about it, you need to think about when you need quick access to cash. If you're on your 20s, it could be that you're on your way to a Thailand holiday, you're saving up for it. If you have it in equities and an airline announces a special, you can't get that money out quick enough if the markets are down to pay for that ticket. If you are in your 30s or your 40s, it might be that your medical savings account is starting to run out and you quickly need cash just to pay for unforeseen medical expenses. Now, you don't want to go into debt for that. You surely would want some cash buffer somewhere. If you are older, yes, you'd want less risk and then you go into cash. But it's also an income thing. If you're a higher income person, you also want a bit in cash because you also need that quick access. And if you have a lower income, you definitely need that cash buffer in case there's an emergency and you don't want to go into debt. Exactly. So cash is something that everybody should have in their portfolio. The proportion of your portfolio that should be in cash, that depends on your personal situation.
Okay, and that obviously would be in a conversation with a financial advisor to look at the risk profile and some of your needs going forward. But if we do take a look at cash investments, one of the criticisms has always been that, okay, fine, maybe prime might be at 10.5%, but when I put my money into a 32-day account or a 6-month fixed deposit, I'm not getting 10.5% return here on my money. How does it work?
Yes, so the prime rate that gets quoted is very different from the rates available for different products out there. And typically your rate that you get depends on how long you're willing to place your money in a bank. If you're willing to place it for, let's say, 3 years, you can easily earn up to, let's say, 9% in interest. Whereas if you're willing to only place it overnight, and by overnight I mean, if you think about it, it must be available, then you're going to get a much lower interest rate. But you still get interest on it. Exactly. And I think that's the important thing, is don't let your money just lie somewhere in a check account, or let it lie somewhere on the kitchen table, or somewhere safe in a bread box. It needs to be there where it can work for you. I think that's where compound interest comes in as well.
Tell us about that, the eighth wonder of the world, and we often hear interest on interest, but give us an example, and maybe even referencing some of the products that FNB might have, you know, just how powerful compound interest can be.
So the wonders of compound interest is, as long as you can sit on your hands and sit quietly and not touch that money, you do get the money to work for you without doing anything. Simple example, let's say you put 100,000 Rand now in, let's say you did it exactly a year ago, before we had the 4 interest rate cycles, the hikes, versus if we didn't have it now. You would have had an interest of about 5%, it would have gone up to now 6.25%.
Sure.
If you look at just the interest and the amount of interest that you would have earned more, you would have earned 26% interest more, going from 5% to 6.25% and keeping the money in them. So even though your interest is only up by 1.25%, your compounding means that you actually get 26% more interest than what you would have had.
Exactly.
Which is fantastic.
It is,
Yeah.
because the interest growing on interest and,
Yes.
like you say, a significant amount of return on the outcome. But if we do take a look at some of the products and the costs associated, as you've mentioned, it depends on your outlook. So a 3-year investment period might be completely different to an immediate account that you might have access to. But what kind of products are we looking at here? And I say this because some viewers out there might think that a tax-free savings account might also be used for short-term benefit,
Oh,
but
yes.
that's the opposite, right?
Well, tax-free savings you can use. The idea is actually with tax-free savings that it's as a buffer so that you do not touch your retirement money.
Yeah,
So
in the
that's
long
the
term.
idea behind tax-free. In general, though, cash products are quite simple. Try and look for the innovative features there that sometimes help you get a better rate or a better functionality. But the point around cash investment products is that they must be simple. There are no fees involved. You were talking about an advisor earlier, but you don't always need an advisor to advise you on a cash product. You basically need to check how much access do you want to your cash. If you can sit on your hands for very long, do a fixed product and fix it for 3 years or 5 years.
Yeah.
If you're not sure when you're going to need it, take a step down in terms of term, but you still get a good rate, go for a notice product. Like, for example, a 32-day notice product. Look for, again, for innovative features where you can break that 32-day notice earlier than 32 days, but know that there will be some penalties involved with that. Go for what some banks have, and we have it at FNB as well, a flexi fixed product,
Yes.
where it's fixed, but you can access a portion in case of emergencies, which is good as well. Otherwise, go for a demand product, which we call demand, which would typically be a call, a money on call.
So when I need it, I can wake up tomorrow morning and decide, I need $5,000 from that account.
It's immediately available if you go onto online banking. We have a product called Maximizer, Money Maximizer, which is a beautiful product. It gives you the same rates as your money market funds, but with a money market fund, you typically have risk involved. So the returns can be great, but there's also risk involved. So with Maximizer, you get exactly the same returns, but there's no risk involved, which is quite a beautiful product, and it's growing incredibly fast in our stable at the moment.
To sidestep for a moment, what about savings accounts, or rather call accounts, these savings accounts for children? And I say this because with them, the cycle and the outlook is slightly longer, and interest rates can go up or they can go down within a 5-year period versus what we're aware of for the next, 6 to 8 months. But would it be advisable at these current rates to actually open up some kind of account for children?
So it's so interesting when you talk about the long period. I don't know if you're aware of our interest rates in terms of when last we were at 7%. So if we look at 2009, we were last at 7%, but that was coming down. We were also, I'm talking now, the repo rate is 7%, the prime rate at 10.5%. So people might go, why should I invest? The rates were coming down, we were at 10.5%. If you wait long enough, it is always worth investing. The question is, are you investing for your child, or are you teaching your child to save? If you're investing for your child and it's really long term, I wouldn't necessarily go into cash then. I would go into alternative asset classes, equities, funds.
Okay.
If you're teaching your child to save, then by all means, do one of these cash products. You go with them, sit on the internet banking screen, show them how to use it. It's in their own name. We have a product like that called My First Savings. It works beautifully. The client has, or the child has, access to a portion of their money immediately, and the rest of their money only in 5 days. Because we feel 5 days is long enough for a child to wait.
And teaching him discipline, right?
Exactly. So it's a bit of instant gratification to buy that quick little book or sweetie that he wants, but also still saving for the bicycle. And if after 5 days they still want the money, then we know they really do want the money.
Exactly.
And then we create a nation of savers. We do not have savers in this country, or not. The average person is not a saver. So we need to create that culture.
Exactly. Sounds phenomenal. And again, highlighting the need for us to take advantage of these high interest rate cycles. But we've said quite a bit. Let's get a quick recap now of some of the key takeaways from tonight's discussion. Lezanne, we've certainly said quite a bit, but before we wrap up the show, for the viewers who are watching out there and are hearing about rising interest rate cycles, perhaps give us a reminder in 5 points as to why we need to take advantage of these rising interest rates for our benefit as savers.
So the last time we had interest rates increasing from the 6% in repo, in other words, in the 9% up over 10%, was in 1981.
Sure.
Since then, we've had fluctuations up and down, touching the 10.5% and going back up again. But I don't know how many people can think back to 1981. So it is a wonderful cycle to be in such a rising interest rate cycle. Make use of compound interest, because then your money works for you. Make use of a very simple cash investment product. Make sure that there's always a portion of your portfolio that does sit in cash to allow not only for the risk profile, but also to allow for quick access to your money. It's straightforward and it's beautiful.
Exactly. Thank you so much for your time today and showing us the positive side to interest rate rising cycles. That's where we leave it tonight for Personal Finance. A big thank you once more to Lezanne Human, the CEO of FNB Savings, Investments and Fiduciary, for joining us tonight. If you have any questions, get in touch with us and share your views. You can tweet to @CNBC Africa using the hashtag Finance410 or to myself @Gugulethu. Until next time, happy saving.